Hello guys, thank you very much for joining in. We're going to be starting about this chapter, which is corporate bond, a quick summary of this chapter within the next 20-25 minutes. Okay, from the exam perspective, this chapter can give you one question. I'll keep on highlighting what is important for this chapter. Let us start talking about the first module, which talks about the fundamentals and the different types of corporate bond. But before we enter into this corporate bond, okay, what exactly is a bond trading? Majority of these bonds, okay, they are publicly traded, they are traded in the OTC market. The exchange, it is not available on the exchange, it is mostly in the OTC market. When you go to the OTC market, you actually deal with dealers. That means market maker. Now, who are the dealers? I'll give you a very quick snapshot of the same. Suppose you are standing over here, okay, and the dealer is standing over here, okay, and we are talking about a Yes Bank bond, which is for 10 years. Suppose it's a corporate bond, we are talking about that, okay? So when you go to the dealer and you ask for this Yes Bank 10-year bond, he will give you two prices, the bid price and the ask price. Let us assume that the bid price is 100 and the ask price is 102, okay? Now what does this two price basically talks about? So if suppose you want to buy this bond from the dealer, you will have to pay 102. So over here you are buying and he is selling. But suppose you already own this bond and you want to sell this bond to the dealer, then you are selling, the price is only going to be $100 and he is going to buy. Okay, so the difference between both the amounts, which is $2, that is the spread which the dealer is going to make. For you it's a cost, but for the dealer it's a profit because he is providing liquidity to the market. Okay, so that is a basic concept. That gap is called as bid ask spread. If the spread is very high, that means there is very low liquidity in the market. If the spread is very low, the liquidity is very high. Okay, it depends upon what is the demand and supply in the market. Also, if the demand is good, very high, the price will go up. If the demand is very low, the price will fall. This is very normal. Now, what is this next section which talks about bond yield? Okay, bond yield is nothing but the return that you're going to generate on the bond. Suppose we are talking about this Yes Bank bond and it is giving me a return of 10%. Now this 10% has two parts to it. One is risk-free rate and one is credit spread. Okay, how do we see that? So I can compare this Yes Bank bond with a government bond. Suppose there is a government bond of the same maturity. Okay, and the government bond is giving me an yield of 7%. And this Yes Bank bond is giving me an yield of 10%. So this gap between them, this 3% is nothing but my credit spread. Okay, which effectively means that can I write this 10%, which is the yield of the Yes Bank, as 7% plus 3% risk-free rate, which is the rate of return which the government bond is giving, plus the spread, which is 3%. That is what has been highlighted over here, risk-free rate plus a credit spread. Now this credit spread reflects the risk that the Yes Bank is slightly higher risky and there is a chance of default as compared to the government bond. Okay, greater the risk, greater the spread. Very simple. Now they have taken the yield and they have compared over here that if I look at maturity between a corporate bond and a risk-free return means the government bond, the yield spread will increase, okay, as the maturity increases. This is very logical. Think about this. Now if you're investing your money into a government bond for 10 years and the Yes Bank bond for 10 years, if suppose I increase the maturity to 20 years, the Yes Bank is more riskier because in 20 years you don't know what is going to happen, right? So over here what is simply happening, okay, as the maturity increases, the investor will demand a higher return for the risk that they are facing. Okay, so there is going to be an increase in the yield. When the yield is increasing, the price will go down. I'll come to that concept. But now the basic thing that you have to understand is that the maturity increasing, the yield is also increasing. Okay, this higher yield, okay, also comes from the liquidity risk that the investors are facing. Let me talk about the price and yield relationship. Suppose you have bond price of 100. The income on that bond is $10. The yield which you are going to generate is going to be 10%. How come 10 divided by 100? If the price went down, the income is still going to be same, the bond income. So now it is going to be what? 10 divided by 90, which is like 11.11%. If the price went to 110, now the yield is going to be 100 divided by 110, which is 9.09%. So it simply means whenever my price has gone down, the yield has gone up. Price has gone up, the yield has gone down. There is an inverse relationship between bond price and yield, okay, which is highlighted over here. The next part, higher the bond yield comes with a lower yield demand from the investor. Also note that higher bond liquidity means lower yield, which means if there is higher liquidity of the bond, that means it is easy to sell this bond. As an investor, for me, the risk is very low. So I will not demand a higher yield. I will demand a lower yield because the liquidity was very high. That is what the concept is.
Are you ready to ace the financial risk management exam? I know clearing FRM is tough, and to ease out your journey for preparing for the exam, our crash course will help you. Because in our crash course, we have a concise and crisp content covering the entire Swagger book, everything given in the book, and this crash course will give you the edge to pass the FRM exam. So don't miss out. Check out the link in the description.
Next part is bond indenture and the corporate trustee. What is bond indenture? Whenever somebody issues a bond, the corporate trustee has to be appointed, plus the bond indenture talks about the document which write down what is the obligation of the issuer, what are the rights of the investor. Everything is written down in detail in a proper detailed legal terms. What are these legal terms? They are called as covenants. Okay, they will also, the issuer will also hire a corporate trustee, because as a normal investor you will not be able to understand what is written in the document, whether the things which are written in the document, is it happening in the same way or not. Okay, so there need to be somebody who will look at the, will understand the language, who will talk from on behalf of the bondholder. Generally the corporate trustee is a bank or a big financial institution, okay, who will take that responsibility. He will always think from the perspective of the bondholder. Okay, he will have a lot of responsibilities on his face, and he will be charging a fees to the issuer. Okay, he will keep track of the amount of bond issued. He will say, he keep a track of interest that is being paid, the coupon that is being paid, whether the principal is paid or not. Suppose if there is a bond which has been issued, is it going above a certain limit or not? Everything is written down in the indenture, and whatever is written in the indenture, the corporate trustee is supposed to follow it. Now, what is written in the indenture? They are covenants. Okay, they are the terms and condition. Now, the covenants can be positive, financial, or negative. Negative means certain things which the issuer cannot do. Suppose if I have issued a bond on that bond we have an asset, I cannot sell the asset till the bond is available. I cannot raise additional debt till the time the bond is available or it is active. Okay, these are negative or restrictive covenants which tells the issuer not to do certain things. When we talk about positive, okay, over here the idea is that certain things which the issuer is supposed to do. For example, pay coupon, maintain the property which is kept under the bond, maintain insurance, submit his financial statements. So certain things which he is supposed to do. Financial covenants, that means as an issuer, he has to make sure that certain types of financial ratios are maintained. For example, liquidity ratio should not go below a certain level. Okay, then cash reserve ratio should not go below a certain level. All of these things. Okay, corporate trustee will basically explicitly look what is there written in the indenture, and he will only do activity to meet the requirement of the indenture or not. For example, the corporate trustee is expected, or it is written down in the indenture, that he will give report to the bondholders every quarter, and if there is a failure on the issuer side in terms of payment of the interest and principal, he will take action. That basic idea is to make sure that the bondholders' rights are protected. The next part is bond classification. Over here, bond issuers and maturity, there are different types of uh, bond issuers which are available. There are utility companies like water company, electricity company, transport companies like Gati, or for example, you have FedEx who are transporting material. Industrials like Reliance, Aditya Birla Group, financial institutions like bank, they also raise money. International companies like international corporations, which means World Bank, IMF, they also raise money. This is on the basis of bond issuer. On the maturity, 1 to 5 year is called as short term, 5 to 12 years called medium term, and greater than 12 years is called long term. There can be one more bifurcation which is based on interest payment. The first one is very simple. Fixed interest. This is nothing but a fixed rated bond where you know what is the rate of interest we are going to get for the entire term of the life of the issuer. Also, in some cases, the interest can be in terms of a foreign currency. This is explicitly written in the contract. This is the first part. The second is floating rated bond, which is a variable rate. Generally, in this case, you have a reference rate, which is LIBOR plus some spread. Okay, I'll give you a very basic example. Suppose you have issued a bond today at time 0, and in that bond, you have written down that I'll be giving LIBOR plus 2%. Okay, and the payment is going to be every year. So at time 0, we know what is going to be the LIBOR for 1 year, because LIBOR is available every single day. Let us assume that the LIBOR was 7% for 1 year. When we reach at this time one where the actual payment has to be made, so the issuer is going to pay LIBOR plus 2%. That means he is going to pay 9%. Okay. At time one, we'll come to know what is going to be the LIBOR for the next 1 year. Suppose the LIBOR is 3%. So as we reach at time two, the issuer is going to pay 3% plus 2%, which is 5%. LIBOR plus 200 basis point. Okay. So you don't know what is the coupon that you're going to get because it is variable. It is depending upon what is the reference rate. So at the start of the period, you come to know what is the coupon that you're going to get, but you will get the amount only at the end of the period. Third, a zero coupon bond. Now, zero coupon bond, from the name itself, there is no coupon that you're going to get. But at the start, when you buy, you get a discount. Okay, you get a discount to the face value, and you receive the entire face value at the maturity. It simply means like this. Suppose there is a 10-year bond. Okay, I'm buying the bond at 90 and I'm getting back $100. So do you realize after every 1 year, $1 is getting accrued, but it is not being paid to me. The entire $10 of extra interest that I'm going to make, I will only get at the maturity. It is getting accrued, but not paid to me. Okay. So value of the bond grows every year by the implicit interest. So in this case, I started out with 90. Every year, the value is increasing 91, 92, 93. Okay. And at maturity, I get the entire full amount. Now think about this. If suppose after 5 years, suppose exactly on this date, the issuer become bankrupt. Okay, then how much amount will you get? Will you get 100, or you will get the face value plus the accrued interest? In this case, you will get 90, which is the face value, plus $5 of accrued interest. So you'll only get 95, you will not get $100. Okay, that is a very interesting part. So you'll only get the issue price, which is the initial discounted price, plus the accrued interest, and not the face value. The second important part with respect to zero coupon bond is there is zero reinvestment risk. What is reinvestment risk? Suppose if I'm buying any bond, and in that I'm getting some cash flow, and if the interest rate has gone down, I'll have to reinvest that cash flow at a low rate of interest. In a coupon paying bond, I'm getting a coupon every term. So I am always facing this reinvestment risk that if the interest rate goes down, I'll have to reinvest the coupon at a low rate of interest. That is one part. But in a zero coupon bond, there is no impact because there is no coupon that you're going to get. Okay, so they do not have to take any effort to reinvest the cash, and hence they are not facing the reinvestment risk. This is the first part. This is the benefit of zero coupon bond. Another benefit is that in a lot of jurisdiction, it is possible to convert the income, bond interest income, to capital gains. That means, see, the accrued interest that you're going to get in zero coupon bond, even though you're not getting that amount, in a lot of jurisdiction it is taxed, but you can convert this tax amount into capital gains. Why explicitly capital gains? Because capital gains are slightly lower taxed in majority of the countries. Okay, so that is why it is more favorably taxed, and hence you pay lower tax as compared to the interest income that you have to pay. If it is treated as an interest income, you have to pay slightly higher tax. If it is treated as a capital gains, you will be paying a lower tax. Let us move forward towards different types of bond that we see over here. There can be a bond which has a collateral. Collateral means there is an asset like a real property or something which is below the bond. If tomorrow the issuer is not able to pay, you can liquidate that property, sell that property, and whatever the money that you're going to get, you can pay to the bond holders. Okay, that is the major part of the collateral bond. Okay, now because I'm putting a collateral as an issuer, I get more power to negotiate. I can issue a bond at a low rate of interest. Let us go in more detail with respect to these collateral wala bonds. The first is mortgage bond. Generally, in this case, you have a collateral, which is your property or something like that. Okay. In this case, if tomorrow the bond issuer is not able to pay, the bond holders have the right to sell off the property and get their money back. A lot of these mortgage bonds, they have restricted future issues. Suppose there was a property and I have issued a bond on that property. I cannot use the same property again to issue one more bond. So I can restrict the future bond issue on the same collateral. Also, there's a concept of after acquired clause, which means that the bond issuance, the asset acquired after the issuance of the bond, that has to be used as a collateral only for existing bond holders. It cannot be used for this same point. If I have used a collateral and on that collateral I am issuing a bond, I cannot use the same collateral again for next bond issue. That clause is called as after acquired bond clause. I'm putting it as star. Collateral trust bond, suppose I do not want to keep collateral as a property, physical property. I want to use a financial instrument like some stocks, bonds, notes, or some similar obligation. I want to use that as a collateral. That is also possible. That is called as collateral trust bond. In most cases, you can the underlying asset can be the shares of the owner of the company. Okay, and that is treated as a collateral. In a lot of cases, you also keep the shares of subsidiary companies as a collateral. Now, who hold this collateral? Trustee who will hold this collateral. And if tomorrow the issuer is defaulting, the entire benefit of the money is passed on to the bond holder. Okay, so they are basically there to protect. The collateral is basically there to protect the bondholders. But there is a very interesting point. Suppose if I'm the owner of the firm and I have put my own personal stocks or shares as a collateral, I still hold the voting rights. Okay, even though I've given that as a collateral, okay, I still hold the voting rights and I still retain the control over the company, especially my subsidiary. So it has been written down in the contract. Also, if suppose tomorrow I have given a collateral worth $100, if the share prices goes down, then I will have to if the collateral value falls below a certain level, I'll have to either put additional collateral or I'll have to repay the amount. Okay, so I'll have to contribute additional security to bring back the collateral to that level of the loan so that the bondholders are protected. Next is equipment trust certificate. In this case, primarily what is happening, there is a company, say for example, Air Asia. They want to buy a plane. Normally, in a normal process, what they will do, they will issue a bond, they will raise the money, and they will buy the plane. But in an ETC, equipment trust certificate, they will first go to a bank or any company, say for example a bank, and they will ask them that I want to issue an equipment trust certificate, help me. So they will create a new trust. Okay, and this trust is going to sell equipment trust certificate to investors. Okay, and suppose they collected around $80. The value of that airplane is say $100. So Air Asia will contribute $20. There is $20, there is $80 combined. Now we have $100. This $20 is a down payment. Basically, we think it that way. Okay, $100, and that $100 is used to buy the plane. But who is the owner of this plane? The trust is the owner of the plane. This is very interesting because if tomorrow Air Asia defaults, the investors are facing very, very low amount of risk because the ownership of the asset is with them. In a normal mortgage bond, collateral trust bond, the ownership is still with the actual issuer. Okay, so this is more protected, right? That is what the core concept of ETC. The piece of equipment underlying the bond is with the trust. Okay, this is very different than the usual agreement because in this case, the trustee will purchase the equipment and will give it to Air Asia. Okay, because now the owner is with the trustee, he will give that airplane to Air Asia. Air Asia will keep on using it and they will start paying rent. That rent is passed on to the investor as coupon. Okay, the rent is passed on to the holder of the ETC. Okay, if suppose the entire debt amount is paid, you can also sell the same aircraft to the borrower, basically the Air Asia. Okay, if it is a standardized product, this is very interesting because what happens, say for example an aircraft which is a standardized product, if suppose the Air Asia doesn't want to continue, they can immediately go and give it to some other aircraft company. Okay, so you can find an original new borrower if the original borrower defaults. This is the protection is very high in terms of ETC. What is a debenture? These are basically unsecured bonds with no collateral, and because there is no collateral, the interest rate is very high because the risk is very high. They rank below the mortgage and collateral. Why? Because when the company is going to liquidate, the first payment will go in the bonds. The first payment will go to the mortgage and collateral bond, and then it will come to the debentures because they're unsecured. Okay, typically issuers generally issue only one debenture. Okay, then they will generally issue first a secured debt and then they will go for a debenture. If suppose they are going for a secured, there is no secured debt and they're directly issuing a debenture, then there is going to be a negative pledge. I'm marking this as star. What is this negative pledge? Basically what they're saying is, okay, because there was no secured debt, we came first. We are the debenture holders. We came first. Okay, and now the secured bond is issued. So secured bond holders should be aware that the debenture holders also have the ownership in the company. Okay, they are also secured in a certain way. That negative pledge is basically added. What is a subordinated debenture bond? So suppose I've issued a debenture, but I've issued senior debenture, mezzanine debenture, junior debenture. In that also I can keep on issuing more debentures. Okay, whichever debenture is at the bottom of the list, okay, there is more chances that they will not get the money. So the rate of interest is going to be higher. Again, debentures are unsecured. So when you look at the entire flow, okay, first it is going to be secured bond, then will be unsecured bond, which is nothing but debenture. Within this debenture, you can have senior debenture, you can have junior debenture. So whenever the company is going to get liquidated, first money will go to the secured bond holders, then it will go to the senior debenture, then it will go to the junior debenture. That is the flow that they follow. Okay. The next is there can be guarantee. Suppose Tata Motors is basically giving guarantee to a new startup, is Tata Next, for example. Now over here, whenever the bank is going to give loan or any bondholder is going to give loan, they will also look at the guarantor, whether the guarantor is strong enough to pay. Okay, they will also look at what is the correlation. Okay, the correlation between the profitability and the issuer's profitability and the guarantor, which means if suppose tomorrow Tata Next defaults and Tata Motor also default, then there is a big problem, right? So the correlation between both of them should be low. If it is higher, there is a higher risk for the part. Okay, so in a very simple language, if the correlation is very high, the bondholders, their value is going to be very low because there is good chance that both of them will default. But if the correlation between them is very low, then the value for them is very high. That is what precisely being written over here.
Are you ready to ace the financial risk management exam? I know clearing FRM is tough, and to ease out your journey for preparing for the exam, our crash course will help you. Because in our crash course, we have a concise and crisp content covering the entire Swagger book, everything given in the book, and this crash course will give you the edge to pass the FRM exam. So don't miss out. Check out the link in the description.
Let us go to the next section. How do you retire the bond? Retirement means close the bond. One very good way is to wait till the maturity, pay the entire amount and close it. Okay, but there can be other methods to retire the bond, and everything is written down in the indenture. We'll go in detail with all of these. The first method is call provision. It's a callable bond. So generally in a callable bond, what happens is that for certain initial period, the bond is not called. You cannot call, but after that, the issuer has a right to call back. Okay, so issuer owns the right and he has a right to call back or purchase the bond at a fixed price. Okay, generally it is a fixed price. You can also have a variable price. Okay, now whenever this provision is triggered, what is going to happen? The issuer will call back the debt. Now this generally happens when the interest rate has gone down. Think logically. If I have issued a bond at a 10% interest rate, now the interest rate in the market is 3%. So I'll call back the bond which is of a high coupon rate and I will reissue the bond at a low rate which is 3%. This is one reason why generally bonds are called. The second reason would be to eliminate restrictive covenant. It simply means because I've issued a bond, okay, and on that bond there was a property. Now I want to sell the property which is secured and for the bond, but till the time the bond is active, I cannot sell the property. So I'll call back the bond, pay the bondholders, and then I'll sell the property. That is one way. So to eliminate that restriction, to change the capital structure. Suppose my company was having huge amount of debt. I want to reduce the debt. So I will call back the bond, pay the debt, and I might raise more equity. That can also happen. Or to improve my decision making process. Suppose I had taken a bond for a particular business. Now I want to close this business. So I'll repay the bond and I will close the business. So it will give me more flexibility in terms of taking decision. Okay. Fixed price call. This is one way that it can happen. So in a fixed price call, the bonds are called during a particular period of time and you will get a fixed price. Okay. And this fixed price is generally very high and then it comes down lower to the par. That means if the bond is called early, the bond issuer will have to pay a higher amount. Okay. Also in certain cases, there is a no call period. That means in the initial 3-4 years, the bond cannot be called. Okay. There's also a variation over here that if the bond can be converted into common shares, that means convertible bond. So both call option and a conversion option, both are very interesting. Okay. So in this case, call option is often combined with conversion often because to incentivize the investor. Let me see, call option is a right to the issuer, but the conversion option is beneficial to the investor. Okay, so the issuer may already have called the bond. Okay, the issuer is likely to call the bond if the stock price rises significantly to avoid issuing stock at a predetermined price, which will now be considered as relatively low. Now, what this last section is explicitly talking about? Think logically. See, if I've given a bond which has both the call option and a conversion option, if this and conversion option will have a strike price, suppose $100. If the stock price goes above $100, ideally the bond will be converted into stock, because now I'm getting the same stock of the company at a low price, because the current price might be 170. So what would happen? Suppose the stock price is rising, the issuer might, before the investor can trigger the conversion, I can buy back the bond by triggering a call option, okay, or the callable part. This is the first example which talks about fixed price call. The second example is make whole call, which is nothing but the price is decided on the basis of the market rate. Okay, and generally how do we decide? Whatever is the remaining cash flow, we take the present value of the remaining cash flow. And how do we use the discount rate? That is nothing but a treasury rate. Okay, treasury rate plus some premium that is used to calculate the present value. So in this case, it is not fixed price, it is basically decided on the market price. The next is sinking fund provision, through which also we can retire the bond early. It basically means some portion of the debt is retired every year. So, and how do we decide which bondholder will be paid? So we can have a lottery on which we can select the bondholder and he will be paid the amount. This is one way. Or else what I can do is, instead of lottery, I can directly go to the market and in the open market, I can directly buy the bond, which is nothing but retiring the bond. Okay. So bond indenture might give some flexibility to the issuer that every year you can retire from 10 to 15%. You have a range depending upon what is the market condition that you might face. If you find that market conditions are favorable, you might call back higher amount, or you might uh, retire a higher portion of the bond. Okay, there is also a slight variation over here. Sinking fund, there can also be a accelerated sinking fund, which means at the start, initially, the portion of debt that is going to be retired is going to be smaller. As we move ahead in time, the portion that has been retired is higher. Okay, so which allows the firm to call back more in the earlier year, and the firm would do if the interest rate fall in those years. So basically, accelerate means it keeps on increasing. Sinking fund provision also makes sense, because what is going to happen? See, if the value of the collateral which was kept below the bond, if that value is going down, what sinking fund provision can trigger? Retire that much portion of the bond now. So that if suppose the initially bond was issued at $100 and I had kept a collateral of $100, now the value of the collateral has gone 90. So retire 10% of the bond, right? So this is also very favorable for the investor. Also, because you will have to put additional collateral. Instead of that, just retire the bond, okay, as the value of the collateral goes down. The next section is maintenance and replacement fund. Now it is something similar to your sinking fund, but what is effectively happening? Okay, sinking fund provision, it basically means that it is slightly complicated, because the idea is that you want to maintain the credibility of the collateral which is backing the bond. Okay, because you want to maintain. So under the M&R provision, you will have to make sure that the collateral is maintained. If it cannot maintain, just replace the collateral, but make sure that the collateral is there to cover the bond. Okay, the bond that has been issued. Okay, for example, in terms of home, what generally happens when you have taken a home loan, the home is the collateral which is immediately behind the loan that has been taken. You have to make sure that the value of the home is up to date. You have to upkeep the home so that the loan and the value of the home is almost closer. So you have to make sure that that is maintained. One more way is to make sure that you have other way of doing a sinking fund is to keep good amount of cash. Instead of using that money to maintain or replace, we keep that cash available in the firm, which can be used to retire the bond at the later state. Simple. Selling a collateral is also another possibility that is generally done. Okay, that you can sell the collateral, use the proceed to retire the bond. There is a condition. You can sell the asset, but you will use the money to first retire the bond holders. There is also a concept of tender offer, which simply means I want to retire the bond, but I'll give a tender offer, open offer to everybody in the market, and I'll say that I'm going to retire this much percentage of the bond from the market. If you're interested, you can give the bond at this set price. Now, if suppose the announcement is made and nobody is interested, you might have to change the price. But generally, the price that is set Okay, it is based on some discounted discount rate, and also it is based on the present value of the cash flow which is remaining. Basically, there is some logic on how we decide the set price. But market participants who are going to give you the bond back, they should be happy, and then only the bond will be successful. The tender offer will be successful. This is the first section of the chapter. We are going to move towards the next part where the focus is on the credit risk. Okay, now what is the credit risk? Either the issuer is going to default or the credit spread of the issuer is increasing. When the credit spread is increasing, the chances of default is increasing. First point, credit default risk. It is nothing but the customer or the issuer is not making timely payment of the interest and the principal as mentioned in the bond indenture. Generally, what happens is you have rating agency who give ratings to these companies, like the rating agency like Fit, Moji, and Moody's and S&P. They have a rating scale, and based on that rating scale, we can analyze whether the company is good enough or not. So, for example, a symbol is triple A, double A, right? By looking at this rating, we can interpret what is the probability of default for a certain kind of customers, and should I invest into these kind of bond for a particular period of time or not. This is a core risk. Second is credit spread risk. We talked about government bond, yes bank bond. Okay, so suppose there is a government bond which is giving you an yield of 7%. Then there is a yes bank bond which is giving you an yield of 10%. The gap between them is 3%. This is the credit spread. So when you're going to compare it with the treasury, that means the government bond, with your corporate bond yield, the difference is the credit spread. This difference is explicitly for the credit risk plus the liquidity risk that you're facing. Okay, or if suppose that the bond is callable, then that can also add a risk into it. So all of these things are connected. Okay, the spread is generally called as credit spread risk, and this credit spread risk should increase as the economy deteriorate. Why? Because as the economy goes down, the yes bank's value will go down, bond ka value, and the yield of yes bank will increase. When the yield is going to increase, the spread will also increase. Okay, now there is a concept over here called spread duration. It is basically connected to the duration of the bond. Okay, and in this case, what is happening? We are trying to highlight when there is a 100 basis point change in the credit spread, how much the value of my bond is going to change. Okay, for example, my spread duration is 4. It tells me what is my sensitivity. If there is a 50 basis point change in the spread, how much my bond value is going to change. 4 into 50 basis point, that means around 2% change is going to be there in the bond price. The next is event risk. Now, why we are concerned about event? Okay, now the idea over here is that event risk talks about adverse consequences about all the possible event which can happen with the company. For example, there can be merger, acquisition, there can be leverage buyout, recapitalization, restructuring, or share repurchase. It can impact the bond holders. Okay, such event can drastically change the capital structure and also reduce the creditworthiness of the bond company. So this is very important. Okay, so all of these events have to be tracked by the bondholders. In a lot of cases, the bondholder will put maintenance of net worth, which means as a company, you have to maintain such minimum amount of equity level. If it is breached, then you will have to repay to the bondholder the entire amount in one go. This is basically a protection being added for the bondholders. What is the next point? High yield bonds. High yield means the yield is very high, the price is very low. These are risky bonds. These are generally bonds which are lesser than the investment graded bond. Okay, B plus front range of particularity over longer time. These high yield bonds, they generally offer high rate of return. Okay, which simply means because the risk is very high, the rate of return is going to be higher. Okay, but for a shorter period of time, there is volatility because they are also connected to the economy. Okay, there might be very high chances that if you invest into these bonds for a shorter period of time, because there is volatility, the large losses are expected. Okay, there are many types of high yield bonds which are there. For example, there is young company, growing company, they want to raise money. They are not rated by anybody, so they might issue a high yield debt because they want immediate money to grow. Okay, because the future prospect might be very high because they have a technology driven companies that way. Other would be fallen angels, certain bonds which were in the investment rating category, but because of some bad news or some bad business, now they have gone into below investment rated category, and because of which they are facing an impact. The other would be a variation would be deferred coupon bond. It is something similar to a zero coupon bond, in which in the initial few years there will be no coupon, but the coupon payment is going to start after 4 years, 5 years. Okay. Step up bond, the coupon is initially low, then the coupon amount will keep on increasing. Payment in kind bond, PIK bond, the bond is going to give you coupon, but not in cash, but in terms of the bond of some subsidiary company. Okay. Extendable reset bond, the issuer, it allows the issuer to reset the actual coupon as frequently as needed, which means that in a normal fixed rated bond, you cannot reset the coupon, but in a variable bond or a floating rate bond, every 1 year, every 6 months it gets reset. But in an extendable reset bond, the issuer has more right to change the coupon to match the current rate in the market. The next part is recovery rate and the default rate. Now in this case, default occurs when there is a missed payment, okay, or missed payment of the interest or principal. Now, a lot of time, because of the higher probability of default, the customer might not have defaulted, but there is a higher probability of default. So how do we tackle it? How do we look at it? So there are certain formulas which are being given. Issuer default rate is nothing but simple formula of looking at, suppose at the start of the year, there were 100 company which were issuing the bond, and at the end of the year, there were 90. So now the issuer default rate is 10%, because how many defaulted? 10. What was the starting amount? 10, 100. So issuer default rate is going to be 10%. Okay. It basically tracks on how many number of issuers have defaulted. It does not talk about the dollar amount. The second example, which is the dollar default rate, it talks about the dollar amount. It takes into account at the start, suppose $100 million worth of bonds were outstanding, and at the end, only $90 million is left. So how much percentage of the bond overall dollar value has defaulted? Okay, it talks about the dollar component. Now in this case, there are two formulas. The formula that I talked about is this: the cumulative dollar value of default and divided by the value of the company's dollar value at the start. But this formula is explicitly talking about the weighted average. Why weighted average? Because all the bonds are not pending or for a same amount of duration, because everybody will have a different number of years outstanding. So basis that we calculate the weighted average of all the bonds that is being over here. There is one section over here which talks about recovery. Now this is not very important from the exam perspective. What they're telling you, that the more senior bond that you have, okay, the better chances that you have a recovery of the amount when you're investing into bonds. So on an average, you get 30%, 38% recovery as per Moody's report. What is the expected return? Whenever you are investing into any bond, okay, you get risk-free rate plus credit spread. Suppose the 7% risk-free rate plus 3% spread, that was the extra credit risk that you're facing, minus you have to take into account expected loss. What is expected loss? It is nothing but probability of default into 1 minus recovery rate. 1 minus recovery rate is the loss given default. Okay, so suppose my expected loss is around 2%. So 7% plus the credit spread minus 2%, that means you're going to only make around 8% of the money. Generally the credit spread is greater because this is a compensation for the risk that you're taking, right? If the credit spread is not higher, why are you investing into the bond? Okay, so credit spread is over the expected loss is generally lower when the credit quality is higher, which basically means when the company is very good, the credit spread is going to be lower and the expected loss is also going to be lower. The difference between them is going to be small. If the company is very risky, the credit spread will be very high and expected loss will also be high, but the difference between them is also going to be bigger. And in this case, when we talk about risk-free rate, we generally talk about treasury rate, and we try to see how much the corporate bond is paying more. That extra is nothing but the credit spread that we are looking at. So risk-free measure is taken as a base to identify how much yield extra you're paying on this bond. Okay, so with this, we have completed the chapter. I hope you enjoyed the revision part.